Have you ever wondered what really goes into making a financial giant tick? Especially one growing so incredibly fast. How do they handle that kind of rapid expansion, while dealing with all the economic shifts and maybe even challenges you just don't see coming? Well, today we're doing a deep dive into Bajaj Finance Limited, specifically their latest results for the first quarter of fiscal year 2026. That's the quarter ending June 30, 2025. And this isn't just going to be about the numbers. We want to get into the strategic thinking, the market forces, and really understand their approach to the future.
Yeah, and for this deep dive, we've got quite a bit to work with. We've gone through their official investor presentation, the detailed financial results statements, recent press releases too, and we've also pulled key insights from their earnings conference call, the one they held back on July 24th, 2025. So pretty fresh information.
Exactly. Our mission here is to unpack all of that for you. We'll highlight the really important bits and basically give you a shortcut to being well-informed about, one of India's big financial players. You should walk away with a good sense of their key numbers, their strategic moves, and what's really driving things over there. So let's just jump right in. Okay, so let's start with the big picture. Bajaj Finance Q1 FY26. What's the headline? What really stands out from their consolidated performance?
Well, the headline is definitely strong overall performance. I mean, look at their consolidated profit after tax, the PAT, that grew 22% year on year. It hit 4,765 crore. That's a pretty solid jump in net profit.
22%, okay. And their loan book, assets under management, the AUM, how did that look?
Also very strong. AUM was up 25% compared to last year. Reach a massive 441,450 crore. And maybe even more telling, they added nearly, 25,000 crore? Actually, 24,789 crore to be exact, just in the single quarter. Shows real momentum.
Wow, that's a huge amount to add in just 3 months. And what about new loans? Were they booking a lot of those?
They were. A record, actually. 13.49 million new loans booked in Q1. That's up 23% year on year. And they sound pretty confident, too. They're projecting they'll disperse over 50 million new loans for the full fiscal year, FY26. Really speaks to their reach.
And all those loans mean more customers, I assume. How's the customer base looking?
Exactly. Growing fast. The total customer franchise is now over 106 million. 106.51 million to be precise. That's a 21% increase from last year. And they added 4.69 million new customers just in this quarter. Their target for the full year is adding another 14 to 16 million. So yeah, huge customer acquisition engine.
Okay, growing fast, adding customers, booking loans. But are they doing it efficiently? Are costs under control as they scale?
It looks like it, yeah. You can see that in their OPEX to net total income ratio. That's basically, how much it costs them to earn their income. It actually improved slightly, dropped to 32.7% from 33.3% in the same quarter last year. So suggests better cost management, better leverage.
Okay. Now, I keep hearing this term finite transformation. What's that all about for Bajaj Finance? Is it like a big deal for them?
Well, it's definitely a big deal. They're calling FY26 a defining year for it. FinAI essentially stands for their AI-enabled tech architecture. It's all about embedding artificial intelligence across everything they do, onboarding, risk, you name it. They mentioned capabilities are already going live. The goal is boosting productivity, scaling better, and, improving the customer experience. It's their big tech bet.
Makes sense. And wasn't there a leadership change recently, but focused on continuity?
That's right. Anup Saha resigned. To maintain stability, Rajiv Jain, who was already executive vice chairman, has been redesignated as vice chairman and managing director, or VC and MD. His term runs until March 2028. So yeah, it signals stability and continuity at the very top, which is important for a company this size.
Got it. And just quickly, before we move into some of the nuances, there were some share adjustments, right? A stock split and a bonus issue. What did that involve?
Yeah, just a couple of technical things for investors. First, they did a share subdivision back in June. The face value went from 2 down to 1 per share. That doubles the number of shares outstanding. Then, the very next day, they issued bonus shares 4 for 1. So for every 1 share you held, you got 4 extra bonus shares. These moves usually aim to increase liquidity, make the shares maybe more accessible price-wise.
Okay, thanks for clarifying that. So the big picture looks strong, right? Growth across the board. But often, the really interesting stuff, the deeper story, lies in the details. Maybe where growth meets a bit more caution. What's the story with their credit costs this quarter?
Right, this is where it gets more nuanced. While the profit numbers we talked about, PBT, the pre-provisioning profit, they were all up strongly, around 21-22% year on year. But on the flip side, their loan losses and provisions, the money set aside for potential bad loans, that also increased quite a bit, up 26% to 2,120 crore. So they're growing, yes, but they're also having to provision more.
Okay, so the cost of potential defaults is rising. Is there an overall metric for that, like an annualized loss rate?
Yeah, the annualized loan loss to average assets under finance, or AUF, that came in at 2.02% for the quarter. And the management was quite specific. They said these higher credit costs were principally elevated in certain segments. So it wasn't across the board more targeted.
And which segments were those? Where are they seeing the pressure that's driving up these provisions?
Primarily two areas, the two-wheeler and three-wheeler financing businesses. What's really interesting here is that these are actually businesses they're actively winding down. The number of loans they gave out in these segments dropped massively, 53% and 57% year on year. They're signaling low AUM growth for these going forward. So it's a strategic pullback from riskier areas, it seems.
Ah, okay, so they're deliberately shrinking those books. Were there any other problem spots mentioned?
Yes, the MSME segment, micro, small, and medium enterprises. Credit costs were also elevated there. They mentioned taking significant credit actions, which usually means tightening lending criteria. And again, they expect low AUM growth for MSME lending in FY26. It really shows a focus on managing risk, even if it means slower growth in these specific, perhaps inherently riskier areas.
So, despite these specific pressures, how do their actual bad loans, the MPAs, compare? Are they still looking okay relative to others?
Well, the numbers did tick up slightly. Net NPAs, that's bad loans after provisions, rose to 0.50% from 0.38% last year, and gross NPAs before provisions went up to 1.03% from 0.86%. But, and this is their key point, they emphasize these levels are still amongst the lowest in the industry. So relative to peers, their asset quality still looks pretty good.
Okay, so it sounds like they're definitely on the top of the risks. What specific actions are they taking besides pulling back in certain segments?
They explicitly mentioned being concerned about consumer leverage, people having too many loans. So they've taken actions across all their products to, quote, reduce the contribution of customers with multiple loans. They see that as a key pain point. It suggests they're being more careful lending to customers who might already be stretched financially.
And what about loans they've had to restructure, giving people more time to pay, that sort of thing?
Yeah, there was a net increase in what they call stage 2 and 3 assets loans, showing increased risk or already defaulted of about 878 crore. And importantly, that includes 219 crore from restructured standard accounts. These are loans where they've offered some flexibility, maybe a payment holiday, to help customers facing short-term cash flow problems. They noted this was particularly relevant in the MSME segment, suggesting they're trying to help some of those businesses through temporary difficulties rather than just writing them off immediately.
That's interesting. Are the newer loans they're issuing performing any better? The recent vintages, as they call them?
Yes, that's a positive sign they highlighted. They're seeing improvement in the performance of these early vintages across almost all portfolios. The one exception mentioned was MSME. So generally, the loans they've issued more recently seem to be holding up better in the early months, which usually bodes well for long-term quality in their main business lines.
Now, you mentioned unforeseen challenges earlier. Were there any specific regional issues, maybe beyond just economics, that affected them?
Yes, quite significantly, actually. They spoke about political risk impacting performance, specifically in the state of Karnataka. Karnataka is a big state for them, accounts for about 11% of their total balance sheet. They stated they've had to cut business by 40–50% there across different products and have even temporarily stopped their microfinance or MFI business in Karnataka. That shows a pretty direct and quite drastic response to some kind of external localized risk factor in a key market.
Wow. Okay. So moving beyond the core lending, Bajaj Finance also has these big subsidiaries. Let's talk about Bajaj Housing Finance, BHFL. What's its focus and how did it do?
Right. BHFL is their wholly owned mortgage lending arm. It had a really strong quarter. Its AUM grew 24% year on year to 120,420 crore. And its profit after tax was up 21% to 583 crore. And importantly, its asset quality looks exceptionally good. GNPA at just 0.30% and NPA 0.13%. Very, very low for housing finance.
That sounds great. But is the housing market itself presenting any challenges for them?
Yes, they did mention challenges. The Indian real estate market is super competitive right now. That leads to, as they put it, intense competitive pricing and also higher attrition, meaning customers switching providers more often. So despite those headwinds, BHFL clearly managed to grow well and maintain that impressive asset quality.
And is BHFL just doing standard home loans, or is the portfolio more mixed?
It's actually quite well diversified. Home loans make up the majority, about 56%. But they also do loan against property, that's 11%. Lease rental discounting is 20%, and developer finance is 12%. So that mix helps spread the risk and let them tap into different parts of the property market.
Got it. And the other subsidiary, Bajaj Financial Securities, BFSL, the capital markets one.
Correct. BFSL is their stockbroking and depository services arm, also wholly owned. It also showed really strong growth. AUM up 39% to just over 6,000 crore, and payee was up 37% to 41 crore. Reflects the general trend, I think, of more people participating in the capital markets in India.
And were they adding customers there too?
They were. Added about 77,000 new customers in Q1. That brings their total customer base to just over a million, around 1.056 million. So it's smaller than the main lending business, obviously, but it's growing fast and adds a different important revenue stream for the group.
Okay, so you need a solid engine room to power all this growth. Let's get into Bajaj Finance's funding and operations. How much cash do they keep on hand? Their liquidity buffer.
They maintain a pretty healthy liquidity buffer. As of the end of June, it was 14,922 crore. That's a decent safety cushion, gives them flexibility, stability, helps them ride out any market bumps.
And what about the cost of borrowing that money, their cost of funds? Is that going up or down?
Actually, it improved slightly compared to the previous quarter. Sequentially, it dropped by 20 basis points to 7.79%. Now, 20 basis points might not sound like a lot, but on their scale, that translates to real savings and helps their margins. Shows sharp management of borrowing costs. They expect the full-year cost of funds to be even slightly lower, somewhere between 7.60% and 7.65%.
Interesting. I heard they might be shifting their funding mix a bit, relying less on deposits.
Yes, that's a key strategic point they made. Deposits grew, yes, up 15% year-on-year, reaching 72,109 crore. They make up about 19% of their total borrowings right now. However, the company explicitly said they plan to reduce their reliance on deposits over the next year or so. They see that contribution potentially dropping to around 15–16%. This suggests they'll lean more heavily on other sources, things like NCDs, non-convertible debentures, which are bonds, ECBs, external commercial borrowings, often foreign currency loans, and just regular bank loans. It's likely a strategic move to further optimize their borrowing costs and diversify where their money comes from.
And just touching on their physical presence, they seem to be everywhere in India, right?
Pretty much. They highlighted having 4,192 locations across the country. That's deep geographic penetration. And their distribution network is vast, too. Just under 240,000 active distribution points as of June 30th. That's how they reach customers, through all sorts of partners and agents.
Beyond physical reach, what about digital? How are they engaging customers online or through apps?
Their digital metrics are really impressive. The EMI card, their flagship product for installment purchases, has 66.2 million cards in force. Huge number. And their digital app platform has 75 million. Well, 75.09 million net users. Massive digital footprint. They also track something called product per customer, or PPC. That measures how many different products or services each customer uses. It shows their focus isn't just on getting customers, but on cross-selling and building deeper relationships.
Okay, so looking forward then, how is management positioning the company? What are the long-term goals they're guiding towards?
They reiterated their pretty ambitious but consistent long-term consolidated guidance. They're aiming for AUM growth in that 25–27% range, profit growth of 23–24%, and strong return metrics. Return on assets, ROA, between 4.3–4.7%, and return on equity, ROE, between 19–21%. They also put targets on asset quality, aiming for GNPA between 1.2–1.4% and NNPA between 0.4–0.5% long term. So balancing that growth with quality control.
And that fine AI transformation, the AI stuff we talked about, that remains central to the future plan.
Absolutely. They stress their commitment to AI, digital, cloud computing. The goal is always, enhance productivity, scale efficiently, and keep improving that customer experience, really embedding that tech DNA into the company.
And the strategic pruning, cutting back in areas like two-wheeler finance, is that likely to continue?
Yes, they were clear about that. Those businesses, like 2W Finance and also MSME lending, will see, quote, a lot more slowly growth, or might even continue to wind down through FY26. It's a conscious decision, a strategic choice to manage risk and protect the overall quality of their loan book. Even if it means leaving some growth on the table in those specific niches, it shows discipline, I think.
Okay, so let's try and wrap this up. To recap our deep dive, it really looks like Bajaj Finance delivered strong headline growth in Q1 FY26. Profit, AUM, new loans, customers, all looking good. But what's maybe more telling is how they're simultaneously making these calculated adjustments, managing rising credit costs in specific areas like two-wheelers, three-wheelers, MSME, and also adapting to external factors, whether economic or even, localized things like the situation they mentioned in Karnataka.
Exactly. And underpinning all that is this steady commitment to digital transformation. The Fine AI project, their huge app user base, combined with proactive risk management. You add in their clear long-term guidance, and it really paints a picture of a company aiming for that sustained, profitable growth, but doing it with a very deliberate, prudent eye on managing the associated risks.
Yeah, and as we've seen, managing risk while you're expanding so fast often means making some pretty tough calls, right? What kind of stands out from this deep dive, for me at least, is watching how a company like this tries to balance those really aggressive growth targets with the absolute need for strong asset quality, especially when they face new or intensifying challenges like maybe rising consumer debt levels or unexpected political risks popping up in key markets. It kind of raises a bigger question for you to think about. How do financial institutions keep innovating their risk strategies? How do they stay ahead of changing markets, changing customer behavior, while still delivering the profits everyone expects? It's that constant tightrope walk between growth and caution, something to mull over.